Good morning. Glad you're watching Morning Express. Our focus now is on your money. And in studio, we have Chief Economist at Mentoria, Ken Gichinga, joining us. And the conversation today will focus around loans. When is the best time to take them? What interest rates apply best to you? What should you do with the loan that you take? And what should you take loans on? And so we'll be speaking to Ken Gichinga about that and much more. Do ask your questions and comments on Twitter at KTN News, at Michelle Ngele, under the hashtag Morning Express. KTN will be addressing some of these in the course of this live interview. Ken, many thanks for joining us in studio this morning.
Thank you, Michelle.
Right, so let's begin with loans. First of all, a lot of people don't even know what to take loans for, but let's begin with what a loan is.
Right. A loan is a product that's offered by either a bank or another entity in the form of cash. Mm-hmm. And this is cash that you take and you use it for a particular use and you return it with an interest. Mm-hmm. The interest is the income on top of the principal that you had borrowed. For example, if you go to a commercial bank today, they'll tell you they'll charge you at 14%. Mm-hmm. So if you take a loan of 100,000 shillings, it means you'll have to pay an extra 14,000 shillings on top of what you borrowed. Right. And that's how the bank makes its money. Mm-hmm. Yes.
Mm-hmm. I mean, and what are the, say, 3 factors that one must have in mind while applying for a loan?
The most important thing you have to ask yourself is, why are you applying for this loan? Mm-hmm. Kenya is a very young country. Actually, the median age of this country is about 19 years. So a lot of people are actually below the age of 35 years. These are young people who are trying to invest in themselves, maybe get an MBA, the education, or maybe they're trying to get their first car, or maybe they're trying to maybe buy a house, get a mortgage, get on the property ladder. So there are a variety of reasons why people maybe get a shamba loan. So there are many reasons, or maybe for just an emergency. Mm-hmm. Maybe somebody in the family is unwell and you need to get an emergency loan. So there are a variety of reasons. So the key question is, A, do you need it? And why do you need it? Mm-hmm. And lastly, can you afford to repay it? Mm-hmm. Because that's another area a lot of people don't consider, the ability to repay. You take a loan and maybe you don't have a job, for example, or you don't have business coming in, so you have no form of repayment. And these are things that sometimes lead banks to reject some loan applications. Mm-hmm. and accept other loan applications.
Right, right. Yeah. I mean, then what would be the wise times to take a loan, or the wise reasons to take a loan? Because like you mentioned, Kenyans are a rather young population, 35 and below. Right. Most of these would be taking, probably getting their first job and taking a car loan, for example.
Correct.
Or taking a mortgage loan, but we'll get to the mortgage a bit later. So things like that, taking a car loan. Right. People refer to cars as a liability. Right. Not an asset. So is that a wise idea?
It's a case by case, mm-hmm. to be honest, because it can make sense for one person, it cannot make sense for another person. Mm-hmm. I'll give you 2 examples. Think of somebody who's just gotten a job, maybe here at Standard Media. Let's say you live in South B. It's your first job. Mm-hmm. You live in South B. You can easily commute. Right. To get here. Such a person might not necessarily need a car loan, for example. Mm-hmm. But think of somebody who possibly is a salesperson and you need your car to see more clients. For example, maybe you're a bank sales professional, and the more clients you see, the more business you generate. Such a person, their productivity is tightly linked to the ability to move around. Right. So for them, a car is actually helping them move in their productivity. So you'll find in the same company, like Standard Media, there are people who it might make sense to have a car loan, and there are people who it might not make immediate sense, mm-hmm. maybe later on, but maybe not in your first job, for example. So it's hard to say, it can be an asset for one person, it can be a liability for another person. Right. It really depends on your personal circumstance and your ability to repay that loan, because mm-hmm. maybe you have a starting salary and maybe the car loan is taking up half of your starting salary. You still have rent to pay, you still have other personal commitments to oblige. Mm-hmm. So such a person, you might ask, maybe it's not an immediate need for now, but maybe you rise up and become a manager. Then it becomes an important asset, because you have to sort of move around and do a lot more than a starting person, yeah.
I mean, and that's also consider that not everybody is eligible for a loan as soon as you visit, a financial institution.
Right.
But these are also issues that many people are not aware about until they go to apply for the loan and are told, wait, you're not eligible for a loan. So what are some of these things that people need to be careful about?
Eligibility normally implies you're not unable to service that loan. You're not able to service that loan. So when you go to a bank, make an application, let's say you want to buy a Shamba loan, for example, you go to the bank says, give us your bank statements. When they review your bank statements, maybe they see maybe your total income is maybe 50,000 or 60,000, and the amount of money you'd be paying back to the bank maybe would be about 20,000. So they might say you're actually overcommitted, for example, and they might deny that application.
Right.
That's an example. Another reason is maybe you took a previous loan, maybe a previous year, and maybe you didn't service it, and maybe you've been listed by the Credit Reference Bureau. So you actually your data is actually on their database, and it shows, so and so took a loan with another bank. They never fully repaid it. That bank has listed them, so they are not able to qualify for a loan until they go back and clear that previous balance with that bank. So those are some of the issues. Then another thing they look at is sometimes they may even look at age. Sometimes maybe you're taking a mortgage, a 30-year mortgage, and maybe you are about maybe 45 years. For example, they might reject that because they might say you don't have 30 years of working life in you.
Right.
If you're at 45 and you're going to retire at 60, that's 15 years. How are you going to service the rest of the 15 years, when you're retired? So those are the issues that a risk department normally looks at. Yeah.
And as talking of risk, loans are also very risky depending on the situation.
Right.
But what kind of risks are we looking at when one defaults on a loan?
For example, like right now, a lot of companies are laying off employees. Unfortunately, if you look at the business environment, it's not very conducive. If you read the papers, a lot of companies are laying off employees. A lot of these employees have a mortgage. A lot of them sometimes have a car loan. So the question is, will they be able to repay the mortgages when they don't have a salary? Because even if it means getting a new job, sometimes it may take even up to 6 months, 7 months, especially in this current business environment.
Right.
It may take longer than normal. So do you have 6 months of savings in you to be able to support the mortgage? Because normally what a bank does is after 3 months of non-repayment, they consider that mortgage account null and void. They say it's a non-performing loan, and they recall it, which means they either request the entire money back, which of course you cannot afford, or you have to now hustle around. So it can be a very stressful experience for a lot of people who maybe have lost their jobs but still have to service these loans, because it means you have to look elsewhere. But also you're looking for income for other areas because you still have to eat, you still have to move around. So those are the challenges that you have to think about when you're taking a loan. In the event that you lose your job, are you still able to at least give yourself 6 months to continue servicing that loan? Others can be easily auctioned.
Right,
Yeah,
right.
and that's a
I
challenge.
mean, in the current market, in fact, the aspect of loans has been revolutionized completely because initially we had Shylocks.
Right.
Yeah, so if one is not eligible to get a loan from a financial institution that is registered, they moved to the Shylock, but they had very exorbitant prices. And now Shylocks have had what would I say, a revolution, so to speak. So now they have applications and they're online Shylocks, with mobile money and whatnot. I mean, what are your thoughts on this new loans state?
It's I would say there's a historical dimension to this. Back in the early 2000s, in the late 90s, it was very difficult to go into a bank and get a loan. So a lot of people used to get their money either from a SACCO or from a Shylock. And what's the definition of a Shylock? This is sometimes an unregistered entity who charges very unscrupulous rates, but is able to give you the cash on demand. That's the reason a lot of people go to Shylocks. You get your money today or tomorrow.
Right.
But they're going to charge you 40%, 50%. And for a lot of people, unfortunately, they prefer that as opposed to going and waiting 3 weeks, 1 month, and being told that you've been rejected. So a lot of people, and that's why I think the Shylock industry took off. It's difficult because it's very hard to service a loan of 40% unless you are expecting money from another source.
Right.
So that's the challenge. Shylocks would eventually start harassing people. They would start maybe prepossessing your vehicles. So it's not a very smooth experience. So banks offer a much smoother experience, but unfortunately, sometimes that could be a bit slower. They could have a bit more checks. So the question is, are these Shylocks who are coming up, are they going to help people? I'd say be very careful if you're dealing with a Shylock, because sometimes they don't have a written contract. It's a verbal conversation. Sometimes it's their interest rate they're charging is very unreasonable. You don't think about it when you're getting the money, but when you start paying it back, you really start feeling that this is usury. That's actually the right word, usury. So I'd say be very careful. Talk to a financial expert, a financial advisor, and try and go work with a registered entity. The SACCOs, for example, have been the bedrock for a lot of Kenyans who never had access to a bank. So I'd say try a SACCO. A chama, for example, many people have been saving their chamas, and chamas can give you loans. So I'd say exhaust all those other options.
That should be your very last option.
That should be, like an emergency, but even then you should be very careful because a lot of these people, they're not regulated by anybody. So if you need a recourse, I mean, where do you get recourse?
Right,
The banks are regulated by the central bank, SACCOs are regulated by, I think, SASRA, but Shylocks, there's no Shylock Association of Kenya.
Anyway,
Yeah.
all right, so one needs to be careful with that. Let's talk about the types of loans that one has, because there's money you can get directly from the bank, but we also have different kinds of loans. A mortgage is a loan. A credit card is a loan. Yeah, so what kind of loans do we have?
So you can start, for example, let's say you're just a university graduate and you get your job in, let's say, one of the local banks. Some of these banks would even give you something called a shuttles loan, which is because they know you're starting off, you don't have anything in your apartment, you need to buy a fridge, you need to buy a cooker. So some institutions would actually give you internally sort of like maybe even 20, 30,000 shillings or 40 to just go and buy the basic necessities, and they would deduct that from your salary maybe for the next 6 months till you're confirmed. So that's a very basic type of loan. I would say that's a good loan because it's helping you start off in life, because you don't have anything, you're in an empty apartment or empty house, you don't have anything. Then slowly you find people now thinking, okay, now my apartment seems I have a sofa, I have a TV, I have a fridge, maybe I should get a car. You know, sometimes they're very good reasons. Sometimes you just want to keep up appearances with other people. Those are two reasons people apply. You can get a car loan. You could actually get a full, maybe you're buying a Toyota for $1 million that could easily be financed by a bank, or sometimes you could pay a deposit, which I also recommend sometimes. Try and put in a deposit so at least that your repayments are much lower. But a lot of people go for the full end. If the bank can do 100, nowadays they even do 105% financing for mortgages, but that's a whole different story. Yeah, pay that. If you can pay your car loan, maybe over the next, normally they're about 3-year durations. It shows that to a bank that you're a good customer. And if you ever go and talk to them about maybe a shamba loan, maybe you want to buy something in Kitengela for about 1.2 million, they can give you that and you pay back. So it's almost like a credibility assessment. Same thing about credit cards. They look at your salary. If you get a promotion and your salary goes up, a lot of banks are willing to increase the limit on your card. But you have to be very careful because a lot of people take that to mean as I can spend more, but you really have to try and maintain some level of frugality in how you spend, because credit cards also, I mean, they used to charge almost 36%, 37% before the interest rate cap was implemented. So you really have to be careful, because the one challenge a lot of people who have access to credit have is they overcommit. So you get your salary and you know, you're financing a car loan, you're financing a credit card, you're financing, you have a shamba loan, you're financing a mortgage, so almost 2/3 of your salary.
Right, and let's focus more on this credit card, especially credit card debt, because I mean, there are situations where one has more than 5 credit cards and it is in debt in all those credit cards. Why is it, does it mean it's just so easy to get access to a credit card? It
used to be very easy. I think right now they're trying to, because of the interest capping, they're trying to sort of like contain it. But it used to be almost like in the United States where we'd call it predatory lending, where we meet you, Michelle, you work at KTN, we say you've been pre-qualified. For example, here's your card. Normally they would tell you it's for an emergency purposes. That's normally the selling point. And it's a good thing. If you ever have an emergency, it's good to have a credit card where, because you don't have the cash at that point. But often what happens is people rarely use it for emergencies. People end up using it for just consumption items. You know, ladies are very known to buy shoes, you know, go spend out in restaurants and
Especially
movies.
with online shopping and the
Online
credit
shopping.
card 2 months later. It's,
Exactly.
yeah.
And you just have to make 5, 6 transactions and you're already at your limit.
Right.
And now you have to start paying back. So people are more tempted sometimes to go and get to another bank and get another credit card to pay off the
other
first credit card.
right.
Yeah.
And then it becomes a chain now.
It becomes a vicious cycle, in fact, and you stop using that, you continue. So the idea because we all want various aspects of, we all want to increase our quality of life, but also we have to understand that we are earning a certain amount, and we also have to save a certain amount. So that kind of financial discipline is something I wish was taught maybe even from high school into university. So when people get that first credit card, they really know this is for something that's very, very important, and I need to buy it now. I can't postpone it because the opportunity is going to disappear. Unfortunately, that's not the case. Yeah.
And many times when you're trying to apply for a loan, you meet the phrase credit score,
Right.
which is something that can either determine how much you get, whether it's going to be lower or it's going to be higher than what you want. How do you raise and build a good credit score?
It's very simple, by paying on time and not defaulting. That's pretty much it. This is a model we've borrowed from the United States, where your best score is about 800. That's why it is in the United States. So if something like a 700 means you're extremely credit-worthy borrower. You always pay on time. And the irony in the places like in the States, if you don't have a credit score, you can't do a lot of things. You can't even get an apartment. So it's almost like an incentive for you to get a loan. So a good credit score is somebody who's trustworthy, somebody who's dependable, somebody who, and it's okay to say circumstances change, people lose jobs, companies are shut down. But the question is, are you able to communicate with your bank and tell them you're entering a different phase of life, things are changing, can you restructure my portfolio so I can repay it back? A lot of people shy away from doing such a things, and with the damage of now spoiling your credit score. So in the future, if somebody actually wants to give you a loan, they look at that score and you're maybe about 300, they're like, no way, we're not going to touch you.
Yeah. And let's talk about another very confusing topic. This is the mortgage.
Yes.
I understand less than 20% of Kenya's population has taken a mortgage. I think it's
Much
even
less.
much less. I think it's only 20,000 Kenyans actually out of 40 million Kenyans. Why is that? There's so much conflicting information. A mortgage is the best financial decision you can make. A mortgage is the worst financial decision you can make. Which is the right, fact?
I would say if you look at the history of the Kenyan economy, if you look at our parents, for example, when they were working, they didn't have these mortgage facilities. For them, they did business, they made money, they saved, then you buy a piece of land, then the next day you come and pour some sand, and over the course of 3, 4, 5 years, you build a home off your savings. But the financial sector has evolved much more. Banks are growing and they want to offer more sophisticated products to more sophisticated clientele. So you have your 25, 30-year-old, 35-year-old who, instead of wanting to wait till you're 40, 45, you want your house today.
Now, right.
In fact, they say, kama si sasa, ni sasa hivi. So there's that level of, you want to start life earlier and stuff. So banks are like, okay, if you can afford it, we'll extend this to you. So a mortgage is a facility that enables you to buy a house and you repay the bank over normally the course of 15, 20, 25 years, normally. The reason people, as you say, it's a bit conflicted, the understanding, is because some people don't understand, is it possible for me to have my job, have no interruption to my salary for the next 15, 20 years? And a lot of people, especially business people, and SMEs are the bedrock of this economy. They're like, no, in a business, we have lump sums, we make a lot of money in January, then maybe till May, nothing comes in.
Right.
And another lump sum comes in May. So from a bank's perspective, is like, wow, how will they be able to manage this? That's why the reason you find a lot of people who have mortgages are normally people who are employed, people who have that kind of steady income to be able to sustain payments over, you're talking of 15, 20, 25 years. So and we're in a very volatile economy, that things are always changing. So it's a decision only you can make. Like, do I think I can be able to do this? Maybe at some point I might want to do an MBA, or I might want to fly out. How will I deal with that? So there are many issues that you really have to sit down. The mortgage is the biggest facility the bank has for an individual. So it's very important that you sit down with an expert and they look at your situation and they tell you what are your goals for the next 15, 20 years. If you're somebody who thinks you want to maybe move around Africa, move around the world, then you have to be very careful. If you're somebody thinking, okay, I'm settled, I'm happy in my job here, I'm seeing myself retiring in this company, then that's somebody who maybe might want to think about a mortgage.
Right.
So that's what you think about.
I mean, and the numbers are very shocking. 20,000 Kenyans is a very low number. But you know, other than that, you mentioned, Ali, you must have the ability to repay your loan. But what's the best way then to work out the cost of your loan?
Well, they should tell you upfront what the interest rate is. And right now, the maximum they can charge you is 14%. So even if you're buying a loan, if you're getting a loan of, let's say for a car for 1 million shillings, add 140,000 shillings, maybe they'll tell you over 3 months, maybe that'll come to about 30,000 per month, for example. So ask yourself, if you remove 30,000 shillings from your income, you know, how much are you left with? Is that half your salary? Is it a quarter? If it's half, then you need to really be careful because you have a lot of other expenses that you have to meet. If it's something that you think it's something you can hack for the next 3 years, by all means, consider it. So the question is, how much are you earning? So even banks, they look at something called your debt to income ratio and stuff. Out of your income, how much of it is going to service debt? And that's what they'll look at. Yeah.
All right. I have a viewer here who's asking, where else can I get a loan if it's not from a bank and not from a Shylock? Because they're not eligible to get from a bank. And now you're discouraging them from going to the Shylock. So
a lot of people go to friends and family. Sometimes people, when they want to start businesses, they go to friends and family. That has benefits. And it can also have challenges. The benefit of friends and family is maybe you're getting at a cheaper interest rates. So that's a good thing. The terms are much softer than a bank. The challenge is it can strain relationships if you're unable to pay. And sometimes they need that money to do something else. So the question is, are you able to contain that? So a lot of people, a lot of businesses in Kenya is money from friends and family. So the question is, are you good with managing relationships? Are you good with setting expectations? Because you might tell them, my business might take 6 months to pick up.
Yeah.
You know, are you that patient? And they'll tell you yes or no. So the question is, can you clearly communicate? Can you clearly manage those relationships? But if you can, it's a much cheaper source and a much more friendlier source.
And more secure.
A lot of Kenyans use that. But yeah, you have to remember that, yeah, you still have to pay back. Otherwise, you can strain relationships. And sometimes you don't want to strain good family, friends relationships. So that's a challenge that you need to balance.
Right.
Yeah.
All right. And then talking about the different types of loans we're talking about, another one here is asking, what is a secured loan?
It's a good question. A secured loan is a loan that you've provided security. Now, what is security? Let's say somebody in my family is unwell and I needed about maybe 500,000 shillings maybe to take them to India or something for treatment. A bank might ask me, do I have security? Do I have a logbook, for example? That's a security in which the bank can take hold of, and in the event that I can't pay my loan, the bank has rights to own that property or own that car. So normally banks really, really love secured loans because it means in the event that they can't get hold of you, you disappear, or you're unable to repay, they still have a security that they can sell to get their money back, or they can own it.
Right.
So that's the reason a lot of banks right now, especially right now in this age of interest rate capping, right now I don't think any banks want to do unsecured lending. They want to do fully secured lending.
And a lot of questions coming in here. Another one asking, what is a debt consolidation loan? We also have another one asking about guarantors and what a guarantor can do when whoever they guaranteed defaulted on a loan. But let's begin on the debt consolidation loan.
So a good example is some of these young Kenyans who have like 5, 6 loans. Some of these young 30-year-olds, if you look at the debt
Took a
profile.
mortgage, the car on a loan,
You have
and
a
everything
mortgage.
else on a loan,
Exactly.
furnished on a loan.
Apartment is on a loan, you have an MBA loan, you
Right.
have a credit card loan. So you find you have about 6, 7 loans, and it's becoming a pain just keeping up with the payments for each. And maybe you're defaulting on some, maybe you're good on others, but you're still not doing very well.
Yeah.
So a lot of people say, can I sit with my financial institution? Can I aggregate all these debts that I have? Maybe if you combine all of them, maybe they come to about maybe 3 million shillings. Then my bank gives me that 3 million shillings. I pay off all these individual loans, and I just have the responsibility of paying my bank. So it gives me simplicity. It gives me sort of comfort in the sense that I'm not dealing with 7 different people. 7 different people are not trying to call me every single day.
Right.
I'm just dealing with one institution. And in the event that maybe I lose my job or I can't maybe repay, I just have to negotiate with one person. I don't have to go and renegotiate with 7 different people. And I think it can be a very good idea.
Right.
Because it just gives you a peace of mind. And you have one person you're dealing with, and they give you sort of like that peace of mind. A guarantor is somebody who, in the event of a default, a bank can access. Let's say normally this is common with SACCOs. Let's say we are part of a chama. With you, we save for about a year, and I feel maybe I want to buy a matatu. The SACCO should tell me, do you have a guarantor? I'd say, yes, Shell is my guarantor. And that means that in the event that I can't pay or I default on my matatu loan, that the responsibility now is on you to come up, to step up.
And this is the question our viewer is asking. What do I do if whoever I guaranteed is nowhere to be found?
Well, when you guarantee somebody, back in the day, people used to take guaranteeing very lightly. To just, like I used to sit in offices where people just come up with a piece of paper, sign here, sign here, sign here. And it was fine when the economy is good and everything is being paid off. But maybe when things started going south, and people actually realize that the banks, the SACCO can actually come to you, and in your savings they can reduce your balance in your account. Now, people nowadays are far more cautious. In fact, nowadays, to be a guarantor, you need to be somebody very, very close. I understand your circumstances, more so than we just work together. It's somebody, I know you, I know where to find you, I know how much, maybe I don't know how much you earn, but I know we've developed a relationship over a long time, and you're somebody I can vouch for. Basically, you're sort of, I can vouch for your character. That's what a guarantor should be, and that's what it should be. Back in the day, it just used to be a piece of paper that would circulate everywhere, and everybody to the watchman would be a guarantor, Just didn't make sense. So a lot of people nowadays are realizing, because people have felt the pinch, because imagine your savings being slashed off to pay somebody else's.
Because of money you did not use.
Yeah,
right.
exactly.
I mean, that's very painful.
It's very painful.
It's very painful.
So nowadays, people are being very, very specific before they accept on the duties of being a guarantor. Nowadays, people are being very, very specific, and they'll guarantee maybe your best friend or something like that. All
right, and then of course there's peer-to-peer lending, which has gained more traction, especially in Kenya. But a lot of Kenyans are using it as an investment platform where they put in money to lend to others and get it back with interest. But just explain how that entire peer-to-peer lending process works.
It's been there for a few years. I think the largest maybe has been Kiva, the American model, where you get huge, maybe rich people in San Francisco who want to find opportunities in Kenya. So in Kenya, you just put up a business, you should put it online, and people come and sort of fund you. It's a great way because, again, it's a cheaper source of capital. It's a cheaper source of, it's always much cheaper than what you'd get from the bank. And even they get an interest, and they feel like they invested in your development. It's a way of social enterprise, for example. In Kenya, it's taken off in the sense that you can access credit without much hassle. It's a hassle-free. But the challenge, again, is a lot of people don't fully understand, A, how to join these platforms, B, how to set up a profile, C, how to entice people on your project so that they might be willing to invest. If you're just doing something very ordinary and mundane, people might be like, that's not interesting. I don't want to be part of that. So a lot of people, and it's part of salesmanship, ability to sell your project, and yes, in a way that's very enticing. That's another area maybe young people have a challenge with, and that's why you still don't find it. It's still not as strong as it can be maybe in other developing countries.
Right,
And stuff. Then you have
right.
things like M-Shari, mobile loanings. These are another smaller types of loans where the CBA or KCB, they've already pre-scored you. Maybe they've looked at your M-Pesa usage. They can tell, based on your M-Pesa usage, we'll give you a limit of 20,000 shillings. And people nowadays are accessing 20,000 shillings. I think with Equitel, you can even access much, much more based on the internal data that they have on you. So that's another area banks are moving to because it's cheaper, its turnaround time is faster, you get your money like instantly. So that's another area where banks, and that's the reason maybe many banks are laying off people because they're realizing you don't need huge credit departments. You can actually do everything on the mobile phone. It's cheaper, but of course you can't get a mortgage on those things. You can't get a car loan, but something to do with like a 30,000 shilling or 10,000 for your business, especially these people who do day-to-day trading. For them, it's a brilliant source of income.
Right, for good emergencies.
Exactly.
But, when you're talking about calculating the cost of your loan, the entire cost of your loan, does early repayment aid with that?
It does. In fact, I would say the earlier you can repay off your loan, the better. So a lot of banks use something called the reducing balance. They charge you interest on reducing balance. So the lower you're reducing balance, the lower the amount of money you're paying. So if you can pay off your 3-year loan, if you can pay it off in 1 year, in terms of interest paid, you'll have paid much, much less than if you, for example, had paid the full tenure of the loan. So in some countries, it's actually penalized, early repayment, but in Kenya, I'm glad we maintained sanity and we said it's a good thing because it helps you complete your project faster. You can even pick up a new product for another project later on. So it's a good thing. But so the question is, do you have enough income to be able to early repay? A lot of people say sometimes I'd rather take the full duration, but you end up paying a lot more than if you could just sort it out earlier on.
All right. And finally, let's take our last question from social media. Mike here is asking, can I lose my property if I take out a personal loan? We haven't talked about personal loans. Are they secure? Are they the same as secured loans?
No, they're not. As a personal loan can be secured or it can be unsecured. For example, as I said earlier, maybe you need an emergency loan to take maybe somebody to hospital. The bank can just extend to you that 500,000 shillings that you need. That's an unsecured loan. You can also request for a secured loan where you maybe have to submit something like a title deed or something like a logbook, for example. That's a secured loan. So you have two types of personalized loans. You have secured lending, you have secured loans and unsecured loans. Now, if it's an unsecured loan, the process of recovering that loan from you is much harder because the bank doesn't have an asset to go and sell into the market. But if it's secured, which banks nowadays are really preferring because it's much easier for them to turn around, then yes, they can actually, whatever you committed as security, they can actually use that to sell it off. So it depends on what type you have. But you have two types, both of them qualify as personal loans.
Right. And earlier on, you also mentioned, things change with life. A lot of things are unpredictable. So say you take a loan for 10 years and in the middle of 5 years you can't work because of injury, you fell sick and whatnot. There's this thing called a loan protection insurance. Does that apply in Kenya? Just in the case of when you're hurt, and when does it come in place?
Right. It does, and it's a very useful piece of documentation, but it's also very specific.
Okay.
Sometimes they'd say maybe in the event of an accident where maybe you lose your limbs or you can definitely not get a job, then that insurance is triggered. So that's a very specific situation. But for example, if you just decided, let's say you are laid off, it will not be triggered. It will not be implemented. I don't think it will be triggered. Maybe you're fired for maybe something you did, So you really can't say, I need the loan protection to come and kick in. So normally, when you're applying for a facility and they tell you there'll be loan protection, it's very, very important that you ask them what are the situations when the insurance is triggered. Otherwise, everybody who's defaulting will just trigger it off and say, you have a loan. Everybody will be defaulting because they'll know that you have an insurance. So you have to know very clearly what are the terms. And insurance companies are very specific, and they have lawyers who will look at this with you when you go and make a claim, and they'll tell you, In the event you have an accident, maybe you lose your limbs, or you clearly cannot work, or you clearly cannot do A, B, C, D, then you are able to trigger the loan insurance. But if it's just maybe you left your job, or you said the business is not doing well, sometimes, depending, you may not get that kind of relief. So you really, like most insurance packages, you really have to read through the fine print.
Right.
Yeah.
All right. Thank you so much for speaking to us, Ken Gichinga there, the chief economist at Mentoria, speaking to us on loans this morning, when to take them and what to consider while taking them. And that conversation on your money brings us to a close here on Morning Express. Thank you for staying with us. My name is Michelle Ngele. Have a good morning. I'll be back at the top of the hour with Worldview.